John Hanna for CityTV.net here in New York City, and we have Dirk Van Dyke, Chief Equity Strategist at Dijk.com, joining us from Dayton, Ohio. Good afternoon, Dirk.
Good afternoon, John.
So, Dirk, a beautiful day today, right?
Yeah, it certainly is here in Ohio. Feels like springtime.
Yeah. Speaking of spring, we have the allergy season coming up, and I've heard somewhere from some of the newscasts here in New York City that this could be really one of the worst allergy seasons because of the dry winter.
Yep, a whole lot of sneezing going on.
Right. Well, hopefully, with a lot of sales, hopefully for the drug companies, they'll be able to hire more people then, right?
Yeah, possibly.
Yeah, we need the jobs, right? That's the bottom line. America needs jobs right now.
Yeah.
So here's the thing. We were talking about this thing before we actually start taping the show. That the earnings season is over, and what are your thoughts about it?
Well, it got better as the season progressed. Is the best way I can put it. I mean, we started off, and it looked like we were in for a really ugly earnings season. But then you look at the median surprise and the surprise ratio. They just sort of inched up, sort of week after week as the earnings season wore on. Now we still ended up with a below average earnings season. The median earnings surprise was 2.33%, and 3% is sort of my benchmark for a normal earnings season. And since most companies tend to report better than expected earnings, rather than disappoint. Companies sort of go out of their way to sandbag the estimates. And then the surprise ratio was 2.28 to 1. And again, 3 to 1 is sort of my normal. To be more specific, we had 293 positive surprises and 128 disappointments. So that means that we've had 62.7% of the companies report a positive surprise. Which is it's not the end of the world, but it's not as good as we're used to seeing. On the revenue growth front, we're at 6.83% growth. So just a little bit short of the net income growth. So we had essentially flat net margins. 9.01 versus 8.98 a year ago. So it sort of seems like the net margin increase game is getting a little bit long in the tooth. But 6.83% revenue growth, is not the end of the world. So it's been a pretty solid growth from the revenue point of view. Now, I would point out that's a slowdown from what we saw in the third quarter. We saw 11.66% growth, and similarly on net income in the third quarter. And I'm talking about this 467 companies that have reported. The net income grew at 15.0%. So on the net income side, we're less than half the growth that we saw in the third quarter, and we're also substantially lower on the revenue growth side. And sort of looking forward to the first quarter, the earnings growth is expected to actually go into negative territory, down 2.58%. But given again that sort of tendency of more companies to have positive surprises than negative surprises, I still think we'll probably at the end of the day, we have this conversation 3 months from now, we'll be talking about a positive number, but not a very big positive number. for the first quarter earnings growth.
Now, with all of this, upward numbers or positive numbers with the companies that reported, um, are those coming in from sales, or are those numbers coming in because of the cost cutting measures that they've done over the years?
Well, this quarter, the sales growth and the earnings growth were pretty close together. Whereas in the previous quarters, you had earnings growth much faster, which would indicate that a lot of it was sort of coming from the cost cutting side of things. But there has to be a limit to the amount of costs that companies can cut. So again, the earnings growth is inevitably going to slow going forward. I mean, but then again, 2010 we grew 44.5%. In 2011, on top of that, we had 15.3% growth. And for all of 2012, we're still looking at pretty good growth. I mean, the first quarter looks like it's sort of a slowdown. I think a lot of it's probably tied to Europe and the dollar. The dollar was so much stronger in the fourth quarter, and that leads to currency translation problems. But for all of 2012, we're looking at 9.4% growth, which clearly slower than 15.3, but is certainly not the end of the world by any stretch of the imagination.
There you go. Now, the other thing is that what's the latest now in Europe?
Well, it looks like the long-term refinancing operation has been a unqualified success. That was the operation where the ECB said, we'll let you borrow for 3 years, use these crappy peripheral country debt as collateral. That let the banks sort of recapitalize, got them over their immediate liquidity problems. We do have the agreement in place with for Greece. And they got the parliament to pass that, but that still seems like very much of a band-aid to me, and is just going to impose more austerity on Greece, which is going to shrink Greece's GDP more, which means that even 5, 6, 7 years from now, the debt to GDP ratio is not going to look any better. You might bring down the debt a little bit, but the GDP is going to fall almost as much, and an awful lot of pain for no payoff, really, in terms of making the country more solvent. I really don't know why they just don't pull the trigger and have Greece get out of the euro, or maybe form a northern euro and a southern euro. The southern euro being Greece, Italy, Spain, Portugal. Ireland really isn't in the south, but it would fit in with that group, which could then devalue, and you'd have some of the growth from net exports to offset the deleveraging that has to take place on both the public sector, the government debt, and also in places like Spain. The problem really wasn't the government debt so much as very high levels of private debt in the economy. And if you got to bring down both private and public debt at the same time, you better have some ability to export your way out of things. And this program really doesn't do the trick. it's a can kicking exercise, and that can kicking can provide some breathing space. Let the European banks try and recapitalize, strengthen their balance sheets, so when Greece finally does leave the euro, you sort of have the firewall in place, and all the dominoes don't start collapsing everywhere. But the agreement that they've reached really doesn't do the trick. It doesn't solve it long term.
Alrighty. That's Dirk Van Dijk, Chief Equity Strategist at Dijk.com, joining us from Dayton, Ohio. And I'm John Hanna for CDTV.net here in New York City.